but it's a lot more boom and bust in terms of flipping houses than it is affordable housing that's diversified across 300 units. So that's what led me to multifamily eventually. At first, it was the idea of being hands-off passive income. And second was the ability to be sustainable through market downturns, something that performs well in a down economy and a good economy.
This is episode number 1 of the Multifamily Success Stories podcast.
Hey, this is John Bell
and Julian Sage.
And welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, deal makers? This is Julian Sage, and this is the first episode of the Multifamily Success Stories podcast, which I'm super excited to bring someone on here that can really kick off the show, and that is Travis Watts. Travis Watts is the Director of Investor Relations at Ashcroft Capital. For those of you that don't know, Ashcroft Capital is a company founded by Joe Fairless, and Joe Fairless has the longest running real estate podcast. So it is quite an honor to be able to have Travis come on here and share his experience with the dealmaker community. What you're going to notice on the show is that we have a wide spectrum of different types of investors. Now, Travis is of the very laid back, hands-off, full-time passive investor. So he is an LP, which is a limited partner in other people's syndication. So he is just putting up the cash, and Travis is able to come in with the capital to be able to support other investors. So in this episode, we talked to Travis about his experience in starting in real estate and what eventually led him to transition over to being a full-time passive investor in other people's syndication deals. We're also going to be talking about how Travis actually ended up working with Joe Fairless at Ashcroft Capital and what it means to be a director of investor relations. I do want to apologize as this podcast episode is not going to be available in video, and the portion of the introduction of Travis in the show was cut off. There's a ton of golden information in here, and I'm super excited to be able to share this episode with you. If you like my show notes for this episode, go to multifsuccess.com/EP1, or if you like my show notes sent directly to your inbox every week, go to multifsuccess.com/show notes. With all that being said, on to this week's conversation.
It originally got me inspired to get into multifamily. It wasn't even multifamily itself. It was the idea that I could have passive income rolling in monthly without having to be so hands-on with the real estate. So I came from a background of single family investing, doing flips, vacation rentals, all that kind of stuff. And just kind of burned myself out in the process. And I was just over the active commitment part of the real estate. So absolutely had fallen in love with real estate in general for the tax benefits and the cash flow. Just wasn't into managing tenants and driving, looking for properties and that kind of stuff. So that's kind of what led me to be a full-time investor in syndications.
I think a lot of people, when they start off their real estate journey, they kind of have a similar path. Maybe they hear about Bigger Pockets, or they see the ads on TV and they start wanting to invest into, fix and flips. But then eventually, kind of people mellow out to where, now you've gotten into multifamily investing. Can you kind of talk about that first start when you first got into real estate investing? What was your mindset when you first got into it to where it is now?
Yeah, that's kind of a funny story. So I knew I wanted to get involved with real estate, didn't know how, didn't have any mentors. At the time, I wasn't huge into self-education like I am today, where I read tons of books and podcasts and go to seminars and meetups and all that. Back then, it was just kind of me trapped inside my head with what little context I had. My dad had been in single family a little bit, so I got to see just a few properties there from that perspective. And so I was scared, man. I was scared to get into single family. It was essentially all of my money that I put in to that first property. That was a tough first step. And then years later, after doing all the single family, I was scared again, going into multifamily. It was a whole different model, and I was committing 100% to it. Over the course of about a year and a half, I had sold all my single family homes between 2015 and 2016. and gone 100% into syndication. So it was another leap of faith, backed up by a little bit of research and books and stuff. But I really had hit it a lot harder later with having mentors and things like that. So that's kind of how it progressed in my story.
Wow, that's a great flow from really kind of being scared every step, I think you only progress yourself when you know you're doing something different and when you're kind of fearful to take that first step and actually just jump off that cliff. So that's really good to hear. How many properties did you have before you really started going into the multifamily space?
Yeah, so I was involved in all these different business models in the single family space without having defined goals or purpose in the beginning. I wanted some passive income, sure, but then why was I doing fix and flips? It didn't make a lot of sense. So I was doing house hacking. I was rehabbing owner occupied homes that I lived in, selling them 2 years later, tax free. It's part of the tax code. Doing all these different things, had my hands everywhere in that space. And I'm sorry, I just lost my train of thought. What was your question?
That's how long the journey's been. It's been a long time. You had to go way back. But what was your first experience with how many properties did you have?
And sorry, I was getting there. I promise, I was getting there. So it was rotating all the time because I was selling a property here. I was moving every 2 years. So I don't know, 7, 8, somewhere in there. And then eventually I just started kind of, instead of seeing the light at the tunnel, it was the opposite, right? It was like closing in on me. And I thought, oh my God, I already have a part-time job doing this. It's about to become a full-time job doing this. And the fact is, I don't like doing this. The income's fine. The passive income's great, but I really didn't like being in the business of it. So it was around there. And basically the way it went was I sat down to calculate my net worth for the first time on an Excel sheet, taking all my single family homes, owner occupied home, all my brokerage accounts, savings account. I said, what if I liquidated all of it? And I went straight into cash, paid the taxes, paid the realtor fees, commissions, and then I'm left with this lump sum. What if I take that lump sum and I start putting that into syndications, 50K here, 50K here, 50K here, at a conservative cash flow amount? I had to determine what that was. And from there, that's kind of where I found out I could leave the job that I had that I didn't like. I was working in the oil industry, and I could start pursuing other work. I could move to part-time work if I wanted to. I didn't have to work if I didn't want to. There was all these options coming available. That was probably the biggest motivator and the biggest driver, is calculating your FI number, your financial independence number, and then realizing that's possible. You just got to structure it in the right way. And so that was my big breakthrough, like 2015 and 16.
How long have you been actively in real estate?
So I bought my first property when I was 20, and I was in 2009. So a little over 10 years.
So 2009, you bought your first single family rental. And then at what time did you purchase or get into the multifamily, your first multifamily deal?
Yeah, so I rode the single family game up through 2015. And that's when I had 2015, I set all these crazy goals. I'm a big fan of Tony Robbins and mindset and, taking massive action. So 2015, I said, okay, I'm going to read 52 books this year, and they're going to be how-to books. They're going to be practical takeaway. They're not going to be, Harry Potter books. And I did that. That's a book a week. That's intense. And from that, and, with association of podcasts and mentors and all this, came this idea that I really can be a passive investor. It's really just a choice. And it's about finding a business model that makes sense, that I understand, which happened to be multifamily syndications, a lot in the value add space. And so, again, I was fearful. I did one deal. That's it. Just did one with a local group in my own neighborhood, and I just wanted to know this was a real thing and that it could actually be possible. And from there, gave it a few months to make sure distributions came in, reporting happened, it wasn't a scam, all that kind of stuff. And when I realized it was real, I went all in. I said, okay, everything's going up for sale. This is what I'm going to do. And it took some time, but it's been fun. So,
any horror stories along that ride? Like, did
Yeah. Oh yeah. Oh yeah. It's not all rainbows. So the first few deals that I did, not the one I just alluded to, but a couple other of the first ones were with groups that I really liked the sponsor behind the scenes as a individual, as a person. And that really sold me. I just thought, man, I resonate with this person. I'm aligned in philosophy. However, they had no track record. They hadn't really actually done this before. One of them, I think, did one or two deals previously, but not exactly the business plan that we were doing in this particular deal. What ended up happening is we did buy a good asset. We did buy it in a good market. We did buy it at a good time, but they completely butchered the business plan in just about every way that you could. And everything in terms of that went south. And the lesson learned was, a 5 to 7 year hold, which is what it was supposed to be in the syndication, ended up being 18 months ish. And they had to put it up for sale because they didn't know what they were doing and they didn't want to make it worse. And they could kind of see the writing on the wall. But we ended up as limited partner investors being profitable. So that was kind of the lesson learned is, at the end of the day, I love the asset class. I love the value add component to it. And as long as you're investing in good markets and buying at good prices and, not forcing numbers to work, it can be good even without, a super crazy track record, GP operator. So I don't know if it's a horror story, but those were some of the early lessons learned. And then what really came to mind, I'll share this real quick, was I started, I've got about 80% of my portfolio in things I know and understand, and about 20% in experimental. And so that's anything else out there in the world that can produce cash flow or passive income. And I made a few investments there that went completely south where I lost a ton of money. And lesson being, invest in what you know, invest in what you understand. And I was not doing that. It was just play money, kind of, so to speak, and ended up pretty bad. So,
I think when a lot of people start off in real estate investing, they tend to stick to maybe fix and flips almost as like a safety net because it's tangible. It's something that like you said, you can understand it, you can be there, you can touch it. But when it comes to multifamily syndication, I mean, even the word is a little bit scary. So people that are just starting off, how do you transition over to being, a person that's in the weeds, like in the field, to a person that is maybe just like more of a passive investor in a larger deal?
Yeah, the first thing to point out is I don't think everybody should be a full-time passive like I am. I'm by far the minority in this industry in that regard. I think a lot of people that are investing in syndications are busy professionals that are career focused on something besides real estate. So they're not really fix and flippers. They're the doctor, the dentist, the lawyer, attorney, the athlete, what have you. They're folks that make good money doing what they do best. They want to park some excess capital because they're often high income earners, but maybe they don't want 100% in the stock market. Maybe they want to take 30% of that and put it into real estate. So I think that, I don't want to say is a better approach, but I think that's the most common approach, is that it's kind of a balance. For everyone, it's different, 10%, 30, 50. For me, it's nearly 100. But again, that's not the norm. So I think that, and number two, you have to your point, you have to be willing to relinquish control. If you're the type of person that I have to make every decision and I do it my way, it's my way or the highway, syndications probably aren't the way to go. Because the pro and the con here is that you're giving up control and decision-making rights to be completely passive and to be able to diversify among a whole bunch of different assets. The reason I can have 30 different deals and have no time commitment involved in those, that's the trade-off. And again, if you're not willing to do that, then it's probably not the right model for you.
What does the vetting process look like when you're looking at somebody's proposed deal? Just like you said, you had somebody brand new kind of jumping in and trying to do another deal. How do you avoid that pitfall moving forward?
Yeah. So, and I talk about this quite a bit, but I'm not opposed to investing with new groups. So sometimes that's a misconception. So if somebody's going to be have somebody on your team that does have experience. whether that be a mentor or a co-GP that's working with you, someone looking over your shoulders, verifying that the numbers work and the deal makes sense. There's a lot of programs out there that people are part of. I'm not opposed to investing with those groups. The mistake was, in my case, these were folks that almost just had just the idea, right? It's like they read a book and thought, oh, I'm going to start raising capital. I'm going to start doing deals tomorrow. And it was kind of that. So there was so much enthusiasm and optimism and excitement, but nothing to back it up. There was nothing actually tangible there to say this is going to work out. Just hopes and dreams. So, this is kind of my process. 1, 2, and 3. 1, I vet the sponsor. And 2, I vet the market. And 3, I vet the deal. And it comes from that experience that I shared with you as just one example early on, that we bought in a good market at a good price and the deal was fine. It was the sponsor that failed it, but it still was successful. So, it's a balance between the 3. But, as long as you have 2 of 3, you got a decent chance here, but any less than that, and you might be looking at some trouble.
So 2015 is when you kind of started your multifamily journey. And now you have over 6,000 properties that you are co-owned and you're working as part of Ashcroft Capital. Well, how do you get to that point? So was it just like that, or over the span of 5 years, it's been, a slow and steady, or was there just like a pivotal moment when things maybe clicked and you really started to grow?
Yeah, 2015, 2016 was the pivot point. It was a slow start. As I said, I made one investment and had to kind of sit back and make sure this was a real deal. I wasn't about to push my life savings into something I couldn't trust or didn't understand. And then it started to quickly pick up. So what I would do is, what made me uncomfortable also in the single family space is I had so much equity in one asset to where I didn't feel comfortable with it. All the what ifs, right? What if it floods? What if a tornado hits it? Like, I didn't like having that much capital in one spot. So what I would rather do, or what I did do, say I sold one of my rental properties and there's 200 grand. Well, I would take that and there's 4 different syndications, 50, 50, 50, 50. So now I just did 4 deals, in a few months or something like that. So it was a quick hurry from like 0 to, 15 or something. And then it's just kind of staggered along since then as I've acquired just one here and one there over time.
And being a part of, because one of your roles as part of Ashcroft Capital is being the business relation, being a part of a team, is that different than just being a passive investor in a deal? And what does that relationship kind of look like?
Yeah, so kind of how that evolved, good question, is basically that when I hit the FI number, the financial independence number, so now what that meant to me, it had nothing to do with money. It had everything to do with options. Now I had an option. Do I want to do the oil field job that I was doing where it was 100-hour work weeks away from home and overseas? No, that sucked. I hated that job. So number 1, I wanted to leave that job. Number 2, what was I interested in? Well, numerous things is the answer. So the first thing I did is I went to go work for a brokerage firm. I wanted to learn stocks, bonds, and mutual funds. I wanted to know the Wall Street model. I wanted to kind of master that plus real estate to be this, financial guru, I guess. And really fell out of love with that model very quickly and went back to real estate. So I started working for a smaller syndication group. And then after that, I started working for Ashcroft Capital because I had been investing with Ashcroft for several years. And I just really liked, their business model and what they stood for and just kind of how the deals were performing. And so it's something I could really back up and stand by. So that's kind of what led to it. I'm in an investor relations role leading up to COVID, traveling the US, going to seminars and summits and real estate meetup groups and just meeting investors nationwide, just talking about passive investing and passive income and syndication education.
So is Ashcraft Capital, is that a place or a source where people can go and actually try to invest in syndication deals?
Yeah, so Ashcroft Capital is a multifamily value-add syndication firm, New York City based. They do a lot of deals in Dallas, Fort Worth, and throughout Florida. And we're talking about, 200 to 600 unit co-investment opportunities for accredited investors, high net worth, high income individuals. And yeah, they absolutely have at this point 506c offerings, which are generally solicited offerings, but it can only be for accredited investors. So that's really kind of what I help educate on. And a lot of the investors in my network are doing that type of investing.
So as you're going out and you're helping to, kind of spread the message of Ashcroft Capital, you're also actively investing in the space. How do you weigh, while you're working there, growing your portfolios? Are you just dumping everything that you're making as a return into your investments, or are you looking at other types of investments and thinking like, how do you diversify when you are more heavily on one particular business?
Yeah, good point. I invest with a lot of different groups. Ashcroft has just been my favorite group in terms of my wife, me, family members that have invested. But with that said, we invest with a lot of different people in the space. So I get kind of that wide array of kind of how this stuff works and the good and the bad. And, it has a lot to do with just knowing your own criteria and what's important to you. Years ago, sat down with my wife right before we were married, and we were talking about this dedication to being passive and what that would mean and what was important to us, and had a lot to do with getting along with the team, because this is a long-term relationship. You're going to be in communication with these folks for 5 years, 10 years, 7 years, who knows, depends. And we wanted, accurate reporting, timely responses, monthly distributions, value-add deals, larger projects, all that kind of stuff. So, I think at the end of the day, that's probably the most important thing to point out to people, like who to work with. Ashcroft may not be the right group for you if you're looking to do new development projects, or you're looking to invest exclusively in Phoenix, Arizona, or, what have you. They don't do deals there. So it's getting to know yourself and your criteria at the end of the day. That's probably the most important thing.
What makes you decide who you're going to be investing your capital into? Is there like a particular reason why one would choose something over the other?
Yeah, basically the criteria is what it comes down to. So I'm on so many different people's deal lists because I network a ton, and everybody wants me on their list or whatever as they find out I'm a passive investor. But the fact is, someone then sends me an email 3 weeks later, new opportunity, self-storage unit in Corpus Christi, Texas, blah, blah. It doesn't match my criteria. I'm not going to do the deal. It has nothing to do with the group being good or bad or trustworthy. It's just, passive income is my income. So I look for monthly distributions, and I look for heavy cash flow on stabilized assets that's paying out currently, not in 2 or 3 years. That's why I don't do new development, the primary reason. And I don't do things that are highly distressed, like maybe the occupancy is, 50% or something. And the goal is to get that to 100 over a 3-year period. I just don't invest in stuff like that. So again, knowing your criteria is probably most helpful.
What's the biggest mistake that you see new real estate investors getting into?
Yeah, I would say, so the biggest mistake I made was, I shared with you the 1, 2, 3, the team, the market, the deal. That was flipped upside down when I started. And that was a big mistake. So I'm sitting here looking at a pro forma and thinking, wow, this one says 10% a year and this one says 8. I'm going to do the 10. That's a higher number, just taking it for face value. You got to remember, those are just projections. They're just estimates. And if the team you're working with has never done this before and they don't know what they're doing, and they can't show you any kind of track record, it's probably not going to work out exactly as planned. I'm not saying it won't work. I'm not saying it's a bad deal. I'm not saying you're going to lose money. But that's the biggest thing I see, are people getting caught up in analysis paralysis over, I think this number should be a little bit different, and I think that should be this. And it's like, it's all just a guess. It's anybody's guess. And so you're really betting on the experience of a team to say, we've done this 25 times over. These are our results we had to show for it. And we have high confidence we're going to do the same thing on this deal because it's the exact same business plan, the exact same type of property. That's more important, in my opinion.
Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information. Is there a lot of fear or intimidation from maybe trying a different thing is once you kind of find your niche, your criteria, do you ever kind of move into something different or try to incorporate another type of aspect? Or is it because that's not what you're used to, you just avoid that entirely?
Yeah, it's a good point. So I had a mentor years ago, and one of the lessons was to basically double down on what's working. So, I tried a whole bunch of different things, tried to launch all these little businesses, made numerous types of investments, but nothing really worked until I started hitting a flow in real estate. And so I took that advice, and when you specialize, when you double down on things you really understand, you've got a much higher probability of finding success in it. With that said, again, I put 80% of my investments into things like that we're talking about, 20% in experimental. Some of the experimental's been extremely profitable. It's worked out very well. Others haven't. So, all in all, I don't even know what my ROI in that sector would be, but it's not as high as my multifamily. But that's because I've had some losses too by not understanding what I was doing. There's plenty of investments out there. It can be scary. It can be fearful, or you can have a lot of fear in it with oil and gas and understanding the risk reward ratios and how boom and bust the market cycles can be and all that. You really got to know a decent amount before you go plug in, $100,000 into something like that.
What is one of your experimental or like you just said, the pet projects that you kind of invested in and it was fruitful? What's an example of that?
Yeah, there was one. It was a private company that did first lien notes. Okay, so they were diversified among thousands of these different loans, and they were going public as a company. So they got big enough to actually pull that off. They pulled the funds together, and they kind of just did this big REIT roll up kind of thing, and went public with a 30% return overnight. So just immediately upon going public, just boom. So depending on what you had invested there, $100,000 turns into 130. It's pretty good for an overnight, success there. On the flip side, I invested in a fund that did distressed debt buying. So they would buy, defaulted debt and then try to collect on it for a higher ROI. Well, it was a big fund with a lot of parts in it, and a lot of different people and partners and stuff. I didn't fully understand all the ins and outs, all the characters involved. There was one character we'll just say on the East Coast, and ended up being a Ponzi scheme. So we lost about 35% of our investment overnight, just when that became public. So, there went all those gains that I made on the other deal, right? So you look at it as a flat line all in all, but a learning process nonetheless.
Wow.
How do you fall into something like that? Is it the same criteria of, when you're trying to find a good multifamily deal, how you're vetting the sponsor versus when you're trying experimentals? How do you verify if this is going to be something that can actually work?
Yeah, with the experimental stuff, my philosophy behind it is, it's going to be boom and bust. It's going to be volatile. I usually don't understand 100% of everything about it. I just have a baseline knowledge of how it works and the people involved. And I have, let's say I'm, 70% familiar with it, and I just go ahead and pull the trigger. Unlike a multifamily deal where I'm, 90% plus, familiar with it. So in these instances, you can't know everything. Even when we talk about like a Ponzi scheme, and you think of a Bernie Madoff, he was a credible person up until that happened. He ran a legitimate business. He's a board member of whatever, the NASDAQ. He's a very public figure, right? He's well known. You would have ran a background check on him prior to the collapse, would have come up clean. So you can only do so much, research and due diligence. And at the end of the day, stuff like that occasionally can happen. I've yet to see it in the multifamily space, but it has happened in the multifamily space, just not in anything I've been affiliated with. But yeah, you got to be careful. And that's why, that's my advice. 80% what 20% is kind of, and other gurus have, different takes. I know Mark Cuban's a big thing about 10% Bitcoin. It's the point is don't put all your eggs in one basket, experiment with things that might pan out for you, but don't lose everything trying to learn that way.
Is there anything that you would do differently if you had to start your real estate journey from scratch?
Yes, that would be goal setting for real. When I started, it's funny, I laugh about this all the time. It's, if you would have asked me in 2009, what's your goals? What are you doing? Why are you in, I would have just said to make money. I don't know. I mean, it seems like a good thing to do. I don't know. Real estate's on sale. But I didn't have any goals. I didn't have any passive income goals. I wasn't pursuing anything directly. And as that became clear later in life, it became that my goals were really more about time and options and flexibility. The option to go travel, for 2 or 3 weeks if I want to do that, with my wife. Like I said earlier, the option to work part-time or to leave a job you don't like, things like that. For other people with families, the time commitment to spend with your kids at home. Time really is the bigger asset. It's the bigger why. It's the bigger purpose behind all of this. And so I wish that I would have kind of started with that in mind. I would have pursued things a little differently. Not to say I have a lot of regrets over it, but, I definitely would have done things different.
Part of having a journey, a multifamily success story journey is, you said those goals that when you first started, you would have done some things differently. Would you have, just skipped the whole real estate flipping and gone directly into multifamily investing? Or do you think that experience that you had, over the course of those years helped you and really just made you to where you are able to move forward and make wiser decisions?
Yeah, I get the question a lot as to, should I start as a passive or should I start as a flipper? That kind of scenario. And what it always kind of comes down to is there's two components here. One, you need a way to make income. So for some people who are the doctor, the lawyer, the dentist, the attorney, maybe or the business owner, they've got a high source of income and it might make more sense for them to start passively. Who says you have to go flip a house in order to be successful in real estate or what have you? On the other hand, if you're someone starting with, $10,000 in your pocket and you make $3,000 a month, well, okay, you probably need a way to start building up income somehow. If that's not going to come from a career change, then a fix and flip might be the way to get you there. Everyone's got their own little thing, day trading stocks. I mean, all this different stuff. It's not my world, so I can't endorse that. But I know that people can make tremendous money in it and do, and that's fine. It's just that you have to have some way of building up capital to be able to invest. Because really, passive investing doesn't start making sense until you have a somewhat substantial amount of money. Let's just call it like 500K or something. Until that point, you're really probably not going to reach like the financial freedom aspect of it, which is the most critical part and component of being a full-time passive.
So do you know of ways that people that are not barely, or almost close to being an accredited investor, where they could really kind of stash some money to help grow so they can reach that status and then make bigger and better deals?
Yeah. Well, and that's another common question I get all the time is I'm not quite accredited, but I do like real estate and multifamily and syndications and this whole idea. So what do I do? Well, number one, there's a lot of groups out there, probably the majority in the syndication space, doing 506B offerings, B as in boy, where they can let a certain amount of sophisticated investors into their deals, as long as there's a pre-existing relationship that has occurred and, they document that and all that kind of stuff. So that's one way. Number two is, things change all the time, the ebbs and flows of the investing world. And what we just saw here recently was the stock market take a massive hit. A lot of people are thinking we're going to retest the lows. Who knows? I don't know. I can't predict the future. But here's the fact, though. There was a lot of REITs that hold real estate, much in the same that Ashcroft or any other syndication group would hold, right? They're 200 to 600 unit apartment buildings all into a big fund. A lot of those REITs crashed hard. They crashed 40%. So what that meant was either you can buy it at an extreme discount and then hope that recovers over the next few years. So there's a good equity play that might even be better than a syndication. And for those that never cut their dividend, some of those dividends went from 8% annualized to 16% annualized because of how far the stock moved down. Now, some of them adjusted that, but again, they might adjust it back up later. So there's different approaches to it, in terms of REITs and stuff. There's plenty out there you can get involved with for $10. But again, what's more important is, do you want to start with limited capital being passive, where you have $25 a month cash flow? Is that going to change your life and motivate you to keep going? Or do you want to focus more on equity strategies till you have a substantial lump sum to go put to work passively at that point?
So we're talking about COVID-19. You just brought up a couple points. How has the industry changed on your end? Are you feeling the burn in any way with any of the deals that you're currently in?
Sure. Yeah. So it's been interesting because my focus the last 4 or 5 years with my wife and I has been recession resistant asset classes, not recession proof, but recession resistant. And COVID's a whole little side curve, but basically we're a couple months in to like a lockdown type status. That's 2 months of data worth of rent collection. And across the board, through all these different sponsors I've invested with, our collected rents are very little off from where they were Q1 before all this started really unfolding. And I think it comes down to the essential need of a place to live. More specifically, I invest in affordable housing. So we're not talking about the penthouse suite downtown. We're talking about $1,000 a month rents, middle America, and there's always a demand for that. There just is, and there's not enough inventory for it. You can't really afford to build new product and charge $1,000 rents. You have to get a subsidy. You have to have Section 8 housing. It's very difficult to do. So I like being in those types of sectors. I also invest in self-storage. I also invest in, ATM machines. There's various things out there that you can invest in that are recession resistant. So very little impact thus far, but again, not immune to it. Not saying I'm not going to lose money or nothing's going to go bad. Who knows? Let's give it another 6 months and and reevaluate. But so far, so good.
A lot of people are pivoting their businesses right now, and there's been a lot of talk of pivot, in every sector. Do you think that right now is a good time for people to maybe be pivoting into the multifamily space and away from maybe the things that they were used to doing, like fix and flips or wholesaling or any of these other different real estate ventures?
Yeah. So it kind of gets back to when I made a dedication to be in real estate long term. I thought, I love this enough to say, I'll do the next 30, 40, 50 years in this. What came with that was, okay, then what's a business model that can stay consistent for 30, 40, 50 years in real estate? We all know that everything goes in cycles and has its booms and busts, but it's a lot more boom and bust in terms of flipping houses than it is affordable housing that's diversified across 300 units. So that's what led me to multifamily. Eventually, at first, it was the idea of being hands-off passive income. And second was the ability to be sustainable through market downturns, something that performs well in a down economy and a good economy. So that's why I got involved with it in the first place.
And do you think that people should maybe be looking, especially because you said multifamily, it's one of those asset classes that is more recession resistant. Do you think that people should be, maybe they've been in these other sectors? Should they be looking to maybe go into the multifamily space now, especially with everything that's happening?
Yeah, I think it's wise to think long term, obviously. Now, where I feel for a lot of folks is where they're stuck in like a 401k where they can't make private investments or decisions. You're stuck with your 5 or 6 choices that your employer says you can choose. And it basically comes down to the S&P 500 index or some bonds, and that's it. And so that's a crappy place to be. But what I never liked about the Wall Street industry and the philosophy of, I come from like a FIRE movement mentality to financial independence, retire early, for anyone that's not familiar with that. And a lot of these folks are investing in index funds. Fine. But my thing with that is that we know these have extreme booms and busts. So why put yourself through the bust when you know it's coming, you know it's going to happen? I mean, people in the community understand that and acknowledge that. But it's like, why should you periodically lose 50%? Why should that be part of a long-term strategy when you could be in something that doesn't do that, And so that's kind of been the whole thing that, I've racked my head over that for a long time. But So yes, bottom line, I think that, maybe syndications aren't the approach or the right thing for your listeners or whoever, but maybe that publicly traded REIT that's 40% off is, or, anything else out there like ATM machines or something else that may be a little more recession resistant.
It sounds like you spend a lot of time really identifying who you are and the types of investment vehicles that you want to pursue. Is there anything that you actively, I think when people start off in real estate, they just start consuming everything. They get onto like bigger pockets, and it's just like everybody's saying this thing, do this thing, do this thing. But eventually, you start to weather out and you start finding who you are and what you want to do. What are the things that you're actively listening to or actively inviting still in your life that isn't causing you to pivot a bunch of different directions?
Yeah. So it starts with, again, to your point, knowing yourself, knowing your goals. So you got to think. So I hear this all the time when I ask someone that says they want to be a passive investor. I say, okay, cool. What's your passive income goal? Let's just call it monthly. It's always 10K. I don't know where that comes from. Everyone's answer is 10K. So whatever. So I said, okay, cool. 10K. Why 10K? What are you going to do with 10? Why not 12? Why not 8? Does it have to be 10? And it's interesting because I don't know, that must get thrown out there a lot, this 10K, because the point is you may only need 7. And at that, you could be retired and totally content and happy, paid off house, couple cars, whatever, but for others, it may be 30K. They've got a lavish lifestyle that they're trying to keep up with. So the point is you can set a goal, but that's not the end of it right there. You need to understand why you set the goal and what you would do with that money if you had it. What are your reasons for having it? And then you just go out and you pursue, with intention that, and I'll tell you something that will save people a lot of time, something that I do and have done. But once you've identified that much, so now you want to find somebody doing what you want to do, somebody who's actually achieved what you want to achieve. And you got to find a way to get under them. You know what I mean? Like pay for mentorship or work for that person for free or something. You've just got to, because they can cut the learning curve by decades. And the value to that is just invaluable. It just doesn't even come with the price. So if you have money, pay for mentorship. You don't have money, add value in some way and work for them. Just figure out how to get there. But you can't do that until you have your goals lined out. Until you know why you want to do something, it's all pointless. So one step at a time.
That's one of the things is, you're working with Ashcroft, and for the listeners that maybe are in the multifamily space, that's with Joe Fairless and the Best Ever podcast, the longest running podcast. Was that a strategic move on your part to try to position yourself in that space? And how do you even get into a place where you can even be a part of something like that?
Absolutely, it was. So again, the purpose behind the FI thing is that you have options. And now what I really wanted to pursue was work that I truly enjoy, number one, that I truly believe in, and I'm not working for money. That's the difference. See, I used to work for money. I had an oil field job that I hated. I was miserable. It was a terrible existence. It just kills your soul to wake up at 3 a.m. and get to work and go put in a 16-hour shift and come home dead. It's not sustainable. So Ashcroft and the affiliation here came from me wanting to learn from the best. That was how I saw it. I had invested with a lot of groups. None, in my opinion, were better than Ashcroft. So I wanted to learn their system and process. So how did I approach it? Well, I'll share with you the story. I took out my iPhone on a Saturday morning and I said, "Hey, Joe, this is Travis, one of your investors. And just want to let you know that I love everything you guys do. I love your business model. These are the things that you're doing differently from other people in the industry. And I really appreciate that. And here's why. If there's any way I can work for you guys in any capacity, in any form, I would love that opportunity. And here's my skill set and background. You let me know if I can add value in any way to your team." And I sent it to him, and he chimes back like an hour later. "Thanks so much for that video. That was so thoughtful. We don't have anything for you at the moment." And I was just so devastated because I'm like, it's like the one thing I really want to pursue. But then 2 months later, he chimes back on an email and says, we're opening an investor relations position, and it has a lot to do with travel, which I love, going and attending conferences, which I love, doing podcasts and speaking events and networking with people. And I'm like, dude, this is my criteria. This is what I want. So I applied to it, and that's how it came to be, is through that process. But it came from not going to Joe and saying, I need $300,000 a year. Okay, because I'm worth it. When you take it from that, I mean, no one wants to work with people like that. So you just got to learn to add value to others. So yeah, I'm pursuing what I want to pursue at this time and being able to help others. And it's very fulfilling. And that's the point of having FI, financial independence.
Very good strategy to get where you want it to go. I mean, of course, without the job being posted, you took a stab in the dark, and it really was very fruitful. Everything that you've said actually today kind of relates back and forth to really you just kind of just surveying the field and then kind of just jumping in and going for it. I really like that about everything that you said.
Cool. Well, that's the story.
Is there what's the best way that our listeners would be able to reach out to you if they have any other questions or if they wanted to find out more about what you and Ashcroft do?
Yeah. So ashcroftcapital.com, email for me, Travis at ashcroftcapital.com. I also have an Instagram. It's at Passive Investor Tips. And then the same thing for Facebook, Passive Investor Tips. I'm on Bigger Pockets. I'm on LinkedIn. I'm out there. So I connect with people weekly. I usually set up, I've got like a calendar link with 15-minute calls. And seriously, I love talking to everybody. And that's the truth. If it's real estate related, let's connect, whether it's on house hacking or how to buy your first property, or it's syndications, or it's I'm a accredited investor trying to learn this stuff. I just connect all week with people in all different types of ways. So those are the best ways to reach me.
Awesome. Well, I appreciate it. Thank you so much, Travis, for taking the time to share your multifamily success story with us.
Awesome. Thanks again for having me. I appreciate it.
All right. Take care. Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.